Hello, Amech traders. Welcome to another part of our technical analysis class. So today we'll be looking at candlestick pattern. So for the candlestick pattern, we should know that there are a lot of candlestick patterns, but we're going to pick the most important ones, those ones that are very easy to spot. And we should also note that when we are trading candlestick patterns, we look at them at key zones. Candlestick forms at every time frames, at every stage, or at everywhere on the chart. But what we need to note is that we only look at those that forms at important zones. So what are these zones that we are talking about? We are talking about the support and the resistance levels. So this is where we look at when we are looking for patterns related to candlestick or the Fibonacci levels. So these are the zones that we look at before we say, okay, this candlestick pattern looks tradable, or this candlestick pattern is giving us a signal to either take a buy or to take a sell. So let's start looking at them one after the other. The first candlestick pattern we'll be looking at is the Doji candlestick pattern. So the Doji candlestick pattern is categorized into four different, or we say we have four different types of the Doji candlestick pattern. We have the Doji, the normal one. Then we have the gravestone Doji that actually looks like a gravestone. We have the dragonfly, and we have the long-legged Doji. So these four Doji candlestick pattern now, they signify different things at different zones wherever we find them. So the first one, the Doji cross, which is this, can both be considered a bullish or a bearish signal depending on where it forms. What we are saying is we already know that from resistance we sell and from support we buy. So if we find a Doji cross on at the resistance zone, it's telling us or it's signaling to us to take a sell. And if we find this same Doji at the support zone, it is also signaling to us to take a buy. So it means this Doji cross now can be a bullish signal or a bearish signal depending on where it forms. And the second one is the gravestone Doji. It is actually a bearish reversal candlestick. Whenever there is an uptrend or we are buying and we go to a resistance level and you find a gravestone Doji, it is actually telling you to sell. As you can see that there is a push from here downward, signaling a pressure from the sellers. They are trying to push price downward. So it is telling us that that resistance zone is actually a strong one. So that's a signal to sell. Then the third one, which is the dragonfly Doji, is also considered a bullish candlestick, which is the direct opposite of the gravestone Doji. So this forms in a downtrend at a support level. If we look at the diagram, we can see that we have a push upward, which means the buyers are applying pressure to start buying the market. So it means the market is trying to signal to us that it is reversing away from the initial downtrend to an uptrend. So the last one, which is the long-legged Doji, we call it long-legged because we can see the up and the down, the cross is longer than the normal Doji cross. That's why it is called a long-legged Doji. It shows a period of indecisions by the buyers and the sellers, or by the bulls and the bears, depending on where it forms. If it forms in an uptrend or resistance level, it is a bearish signal. And if it forms in a downtrend or at the support level, it is a bullish signal. It can be considered a bearish or a bullish signal, just like the Doji cross. So if it is found at the support, it is signaling to us that we might actually be ready to buy. And if it is seen at the resistance, it is signaling to us that we might be ready to sell. So that is just that about the Doji candlestick pattern. So this is just introduction to this candlestick pattern. In the next lecture, we are going to actually look at them on the chart and how to identify them. So let's move into the second candlestick pattern. The second candlestick pattern is the engulfing candlestick pattern. When we say engulf, it means something covering completely the other. If we look at this picture that we have here, we can see this green candle engulfing the small red candle. It is shadowing over it. And if we look at the second one as well, we can see this red candle engulfing the green candle. So wherever you see a bullish candlestick, it can be green depending on your color selection, but mostly or most traders use this green and red. So wherever you see a green candle like this engulfing the red or the bearish candle, we call it a bullish engulfing candle. Wherever you see this bearish candlestick covering the green one or the bullish one, it is telling us that that is a bearish engulfing. So the bullish engulfing, it forms, we're looking for it at the support level. That's the zone that we look for, because we say it is a bullish engulfing. It should signal buy, or it should signal an uptrend. So whenever it is seen at a support level or in a downtrend, probably the market was initially selling and we got to a support level and we actually see this form, it is signaling to us that we might actually be ready to buy or to go long or to reverse to an uptrend. So then also for the bearish engulfing, it forms in an uptrend or in a resistance zone. Whenever we see this, it is signaling to us that the uptrend may be ending. What this big candle is telling us is that now we have buyers, a lot of buyers coming into the market while the strength of the sellers has weakened. Then the bearish one is telling us that the buyer's strength has weakened and the sellers have now come into the market. So that is just what the engulfing candlestick pattern is talking about. Then the third one, we have the RME. It looks like the engulfing, but it's just different. The first candle for the engulfing, we see the first candle being a small one, while the second one is a big one. But for the RME candlestick pattern, the first candle is a big one. The bearish candle that we have here is big, while the small candle is going to be within a half distance of the big candle. So for the bullish one now, we have a big bearish candle and we have the small green candle. Then for the bearish one, we have the big green candle and then the small red candle. So for the bullish RME, the first candlestick is a very bearish candlestick, like I said earlier. So followed by a bullish one, which is very short, and it must be completely covered by the first candle, by this bearish candle. So the shadow of this bearish candle must completely cover the green one. So when you see this in a downtrend now, or in an area of support, in a zone of support, it is telling us that we might actually be ready for a buy. And then for the bearish, which is just the opposite of what we said earlier, it said if it forms at the resistance level, wherever you find this at the resistance level or in an uptrend, it is indicating or telling us to go short or to sell. So that is that about the RME candlestick pattern. Moving on to the next one, which is the dark cloud. Just like the name implies, forming a cloud over the order. We have the dark cloud cover. It is a bearish reversal candlestick pattern. Consists of two candlesticks. The first one is a bullish candle showing a very strong upward momentum. That is, you can see that this candle is very big. It means there are a lot of buyers present in the market. But then it is going to be followed by a second candle, which is telling a new story that is different from what that bullish candle is telling us. Now, its bearishness now has to close in at almost midway point, or let's say more than half of the body of the green candle, of the bullish candle. When you have this now forming at the midpoint of this candle, now we say it has formed a dark cloud over the bullish candle. So whenever you see this at area of resistance, it is signaling to us that we might actually be selling or go short at any point in time. So when you see the dark cloud cover in an uptrend, it is telling you to sell. Then the opposite of the dark cloud is the piercing line candlestick pattern, we look for this at the support zone or in a downtrend. So the first candlestick is a very bearish candle that is telling us that, okay, the sellers are in the market. But in the next candle that is going to form is telling us a new different story. It means the buyers are rejecting the pressure from the sellers. And the buy is going to form at the midway point or more than the midway point of the body of the bearish candlestick. So whenever we find this at the support zone, it is telling us that we are ready to take a buy or to go bullish. The next one of the most common candlestick pattern used is the shooting star. The shooting star, you can call it different name. There are different names ascribed to this shooting star. Some call it the inverse hammer, the bearish hammer, inverted hammer, bearish pin bar. Give it any name. But what we can majorly see here from this candlestick, what we can interpret is there's a pressure from above here pushing the price downward. So whenever you see this shooting star formation now at a resistance zone, it is obviously telling you that the sellers are in the market. They are putting in pressure and they want to sell. So whenever you see this in an uptrend on a resistance level, it is a signal to you as a trader that we may actually be ready for sell. Then the opposite of the shooting star is the hammer candlestick pattern. You can see the formation. It looks like an hammer actually. So whenever we see this, let's say at the support zone, it is telling us that the buyers are actually pushing the market upward. They are applying pressure on the sellers. So this is signaling to us that we might actually be ready to take a buy. So whenever it forms in a downtrend or at support level, you should note that this is a very high probability bullish reversal candlestick pattern. So whenever we see this, we should be looking to buy. Then something similar to this hammer. You know, we said we'll be looking at for this hammer at support zone, but you can find something like this at the resistance. When you find this same kind of picture that we have here at the resistance, we call it the hanging man. We call it the hanging man. So what if, or let's say what happens if you see in an uptrend a candlestick that looks like hammer, just like I said earlier? Is it still a bullish signal? No, it is not. Now, the hanging man is exactly like the hammer, but the only difference is that it must form in an uptrend. While we said the hammer forms in a downtrend or at the support level, the hanging man is always found at the uptrend or at the resistance zone, just like we can see here. So it is a bearish signal. It signals to us to sell. So when it forms in an uptrend, it tells you that there is a possibility that the uptrend is ending. So you should be looking to go short. Now, the next one is the railway track candlestick pattern. When we say railway track, it means the two candlesticks look very identical. They are equal. Where you can see the bullish candlestick and the bearish candlestick. When you find this at the resistance, this the first candlestick you'll be seeing is going to be the bullish candlestick, while the next one is going to be bearish. When this forms at the resistance, it is telling us to take a sell, or it is signaling to us actually to take a sell. Then you can look at other confluences before you say, okay, we are actually ready to sell. Then when you find the first candlestick being red and the green candle as the second candle at the support level, it is also a bullish railway track. It is signaling to us to take a buy. So like I said earlier, we have to actually be looking for this candlestick at important zones, not just anywhere on the chart. We must be looking for this candlestick patterns at important zones like the zones of resistance and support. Can also be trend line resistance or trend line support, as the case may be. So then the last one is the spinning top. The spinning top actually looks like a doji. The only difference is that they have a small body. Unlike the doji has no body. It's just a body of it's just a wick. We have a wick, then the body is also a wick. We have no major body that is showing to us that it looks actually like a candlestick, but they are also a candlestick actually. But for these now, the spinning top, they have a small body and they have long wicks at the top and then at the bottom. So spinning tops, they can be continuation candlestick pattern, and at the same time, they can be reversal candlestick pattern. Spinning tops, they have small bodies like we explained earlier, and they can signal indecision. It means the buyers and the sellers, they are still indecisive. They're still waiting to see who is going to come out stronger. So if you see a bearish spinning top in a support or in a downtrend, this can be considered a bullish reversal signal when the high of that bearish spinning top is broken to the upside. So probably you're looking at a support zone and you see a bearish spinning top. It may actually be giving you a signal that the market is ready to take a buy. Similarly, with a bullish spinning top in a resistance level in an uptrend, it can be considered a bearish signal as soon as the low is broken to the downside. If you look at this spinning top, we were actually buying strongly, but here it is telling us that the strength of the buyers has actually reduced. The sellers are coming in and there is indecision, so it may actually be signaling that we are ready to sell. And you can see that the next candlesticks that formed, they're very, very big bearish candlesticks. And then for the bullish reversal, we may actually be selling. Merely will form a spinning top at the support zone. This is telling us that we are probably ready to take a buy, and we can see following the spinning top, we can see big bullish candlestick formation. So those are the candlestick patterns that we'll be looking at, but the common ones that we need to take note of is the dojis. The spinning top, actually you'll be seeing them, they are also very common, just like the dojis. Then you look at the engulfing candlestick patterns, both the bullish and the bearish, railway track pattern, then the pin bars, the hammer and the pin bar. So you watch out for all these candlesticks. They form at key zones on the chart on every time frame. If you look at your 15 minutes, your 30 minutes, your 4 hours, they are actually there. But for you to trade with this candlestick pattern, it is preferable for you to look for them on the higher time frame. So when you look at higher time frame key zones, the zones of resistance and zones of support, and you find these candlestick patterns there, the different ones that we've talked about, they have high probability of playing out on the lower time frame. So I believe this is to some extent very clear as an introduction to the candlestick pattern. So in the next lecture, we're going to be moving into our chart and see how we can locate them on the live chart and how we can trade them. So thank you and see you in the next class.